Welcome to lecture 9 on risk management and insurance. In this lecture, we compare the balance sheet of a bank with the balance sheet of an insurance company. A balance sheet shows the assets and the liabilities of a firm. Now here we consider the balance sheet of a bank. Now the public deposits money with the bank. So the public people, they hold accounts at the bank. Now, those accounts may take the form of a demand deposit, of a time deposit, or of a savings deposit. Now, in the case of the demand deposit, the person who has deposited money can get the money back immediately on demand, as it said. With a time deposit, maybe the person has to give notice to the bank and then maybe gets the money back after 30 days. Now, with a savings deposit, now usually you can get back the money immediately, but then you have to pay some penalty. Otherwise, maybe you have to wait 10 days and then you have to get your money back without the penalty. Now, demand deposits, they're also called sight deposits because you get your money when you want to see it. Okay, they're also called current deposits. They have different names in different countries. Now, demand deposits, because you can have your money immediately back, you can use them to make payments. So demand deposits, you can write checks on it. Or maybe a demand deposit is linked to a credit card. Now, time deposits and savings deposits, you usually cannot write checks on it, as they're usually not linked to credit cards. So it's only the demand deposits that you can use to make immediate payments. So the public deposits money into those accounts, and the bank then takes that money and invests it. And the most important investment of the bank are the loans. So the bank gives loans, for example, to households, and those loans are maybe a mortgage. Or the bank gives a loan to a firm, a commercial loan. Or actually the bank may give a loan to the government. In that case, the loan takes a form of a government bond, or may take the form of a government bond or a treasury bill, which is issued by the government. So the government may issue some treasury bills and the bank buys those treasury bills. So the government gets the money from the bank. Now, the banks earn interest on those security holdings and on those loans. Okay, so that's where they earn the income, the bank. And here maybe the bank may pay a low interest. So the interest rates here are higher, usually higher than here. So the right side of a balance sheet of a bank shows the sources of funds. They include those deposits of the public and then also what's owned by the shareholders of the bank. So here that's the funds provided by the shareholders of the bank. And then the uses of the fund are the investments of the bank. So the money basically flows through the balance sheet of the bank. And we show here the situation at a specific future date. What are the assets and the liabilities of the bank at some specific date? Now, the bank may experience withdrawals here of deposits. And that's why the bank is also hold here some cash items. So those are those liquidity reserves. So people may show up at the bank, or they may draw a lot of checks on the demand deposits, and then the bank must have that money. So here the bank has some cash items. So the liquidity reserves, they are the teller cash of the bank. The bank has some banknotes and coins for teller services in the offices, in the branch offices. But more importantly, the bank holds an account with the reserve bank, with the central bank. And when the bank needs money, it can draw on that account. Now, those liquid cash items, they provide protection against unexpectedly large withdrawals of deposits. So here with the deposits, we have daily inflows and outflows, and maybe on one day, just by pure chance, we have a relatively large outflow, and then the bank needs those, uses those liquid cash items here. Now, if the withdrawals are unexpectedly large, then the bank may become illiquid. So it may run out of cash. Then it may borrow funds from another bank in the interbank market. We have discussed this. Or if that's not possible, it may try to go to the central bank and try to borrow the money from the central bank. Now, do you remember the interest rates here? In South Africa, if one bank borrows cash from another bank, remember it's a SABOR rate. And if it borrows from the central bank, it's actually called a repurchase rate. We discussed this earlier. Now, during the financial crisis in 2007, 2008, it was really that the bank went to the reserve bank and borrowed some money from the reserve bank. So the banks were running out of liquid cash holdings here. People withdraw a lot of money from the banks. They had this outflow of money here, and so the banks ran out of cash. And so they had to go, and the reserve banks and actually provided emergency funding for the banks. So that's a very important role for the central banks. No bank really can actually withstand very large outflows of deposits. Because you see, all banks invest their money here, and so that's relatively illiquid. Now, securities, they can be sold quite quickly, but mortgage loans, until the bank has the money back from a mortgage loan, it has actually to call in those mortgage money, and that's really is time consuming. So banks, if the banks experience large withdrawals of deposits, they will have problems here with liquidity. They will run out of cash, and no bank holds 100% of cash because you don't earn interest on cash. You see here on those investments, the bank is making the money. That's where it's earning the money. So the bank will try to hold very small cash holdings and invest it and earn interest. Naturally, a bank would be 100% secure if it just held cash items without giving any loans. Then if it has only cash, then the banks naturally can always satisfy potential withdrawals here. But that's not very profitable because the bank makes the money. Here the bank earns interest. Okay. Now distinguish between the liquidity reserves of a bank and the capital reserves. Now capital reserves are about solvency. Now when a bank experiences large loan losses, then the capital reserves act as a buffer against insolvency. So it's a bit confusing here. Up here, we have the liquidity reserves. Down here, we have the capital reserves. So don't confuse them. You see, if a bank suffers losses on loans, people can no longer pay back the loans, then here the assets of the bank shrink. Now, if this continues, it's not yet a problem because we have here this buffer stock. That's those capital reserves. That's actually the equity of the shareholders. It serves as buffer stock. So also here we have more and more loan losses. Maybe you have financial crisis. The bank lose money on their loans. Now, if it's really serious, now suddenly the assets of the bank are smaller than the liabilities of the bank, and then the bank is insolvent. Now here, if the loan losses are so large, then the bank has negative capital here, and it's insolvent. Actually, the bank then is broke. So the equity of the shareholders basically serves as buffer stock against insolvency. And sometimes that's also called reserve or reserve capital. So distinguish between liquidity reserves and which are held against unusually large withdrawals of deposits, and capital reserves, which are held against loan losses when people default on their mortgages and firms default on their commercial loans. Now, the Basel Agreement agreements provide for capital requirements and for other prudential measures, so the banks do not get insolvent. Now, South Africa is taking part in the Basel agreements and has implemented the so-called Basel III agreements. So those agreements set certain capital requirements for the bank that this buffer stock here then is big enough. The banks are legally enforced to hold those reserve items here, or this equity. Now let's look here now at the balance sheet of a bank, of an actual bank. Westpac Banking Corporation, it's an Australian bank. Now here we are on, so this is actually the asset holdings of the bank on September 30th on a specific date. And the biggest asset holding here is the loans. Those mortgage loans and maybe loans to businesses, that's where the banks earn interest. That's by far the biggest item here, $700 billion out of a balance sheet total of $900 billion. What you also see is the cash items and balances with the central bank. They are very small, only $20 billion here. So that's actually only about 2% of the entire balance sheet is held as a cash item. So the cash items of the banks, they are tiny. That's, as we just mentioned, that's because the banks earn no interest on those cash items, or only very low interest. The banks prefer to give loans and hold securities where interest rates are higher. That's where they make the money. And so they squeeze the cash holdings to about only 2% of the entire balance sheet. And then naturally the bank may run out of cash if it has unusually large withdrawals. So the banks can actually try to borrow in the interbank market, or will go to the Reserve Bank and try to borrow new cash items from the Reserve Bank. Okay, the other items in the so the biggest item is here some loans. So we also here have some security holdings. They are also pretty big. So those are actually bond holdings. So maybe here the Westpac has bought government bonds. But the loans to households and to business firms are much bigger. So the cash items very small, and all the other items are also quite small. You see here, for example, we have property and equipment. So that's the building, the bank building. And that's the car of the director of the bank. Okay, that's that's property and equipment. Okay, very small item. It's actually an asset of the bank. Okay, it's here $1 billion. Now the liabilities of the bank we have here. So the biggest liability are those deposits of the public, 500 billion. So people open up accounts, they deposit money into accounts. The accounts can be, as we have seen, a demand deposit. It can be a time deposit. It can be also a savings deposit. Demand deposits can be used for immediate payments, to write checks on it, or maybe linked to a credit card. So here, those deposits, that's how really the banks get their money. So here also quite a big item here is debt issues. Say here's a bank issues bond-like instruments. It may be called, if it's shorter terms, then it's a so-called banker's acceptance. So it's just securities, like bonds. So the banks are issuing here those credit contracts, and they get money through that. So they take that money and they invest. And the Westpac then here invests the money, and earns interest on it. And then you have here the total liabilities, 800 billion out of a balance sheet total of 900 billion here. So the remainder here is the equity. That's the equity attributable to the owners. That's actually what the shareholders have given, or that's the shareholders' interest in the bank. But it also serves as buffer. So if the assets shrink, then first this equity here is lost. And if the assets of the bank shrink even more because of loan losses and become less than those liabilities here, then the bank is broke. Okay, we don't have to be concerned here about those different items here. Those are just they are economically not important. They are just important for legal reasons. Now, a final interesting item here that we have here is derivative financial instruments. It's $29 billion, so that's quite a lot. Okay, those are the forward and future contracts and the options. Now, those contracts here have positive value, and that's why the Westpac now lists them amongst assets. But it also has options and futures with negative value. And so here we have derivative financial instruments here amongst the liabilities. It's also $29 billion. It's a little bit less. Here we have forward futures contracts, options, also swaps, with a negative value of $29 billion. So it belongs to the liabilities. It's a liability of the bank. Amongst assets, we have those derivatives, 29.8 billion. So actually, it's slightly positive. Okay, what they are out of what they're holding in the derivative securities markets. It's quite very important that the banks also list the value of those forward contracts, futures contracts, swap agreements, options. So that's a balance sheet of a bank. Now let's compare this now with a balance sheet of an insurance company. It's actually quite similar. Now an insurance company, it writes insurance contracts, and so the insurance buyers pay money, and so the insurance company then takes that money and invests it in an investment portfolio. It buys assets. Now, insurance company mostly hold government bonds. They invest into bonds and treasury bills. Maybe they also hold shares. Banks do not hold a lot of shares. It depends on the country. In some countries, banks are allowed to hold shares. In other countries, they are not. So here again, the right side shows the source of the funds. People buy insurance contracts, and so the insurance company has now a liability towards those people. When those people get sick, or maybe their car gets stolen, or their house burns down, then they have to return money to the people. They have to pay for those losses. So it's very similar to a bank account. People pay money into the insurance company, and they get the money back. Now here with the insurance companies, they get the money back if they get sick, or if their car gets stolen, or something else happens. Okay, they have some kind of loss, so they only get it back in a special situation. With a bank, they can withdraw the money actually on demand. Okay, or maybe after giving notice to the bank if it's a time deposit. But it's very similar. People pay money into a bank. People pay money to insurance companies, and the insurance companies and has a liability towards those people. They have to cover their losses if they are sick, or if their house burns down, and so on. Now the insurance company takes that money and it invests it, and again earns interest on that. Now naturally also the insurance company will have some cash items, but they usually are not mentioned separately here. And again the equity of the shareholders, what belongs to the shareholders, the owners of the insurance company, that actually serves as a buffer stock. It serves as a buffer. If maybe those assets of the insurance company fall in value, if it's serious, then maybe in sense assets are less than the liabilities, and the insurance company again has negative value, and so it's broke. So also with the insurance company, you can think the money flows through the balance sheet. On the right side, you see, okay, who paid the money? The insurance buyers, and also, okay, the shareholders gave money, and the insurance company invests that money. Now, those liabilities of the insurance company are actually equal to the present value of all future insurance claims. We will see this again later. So the assets of the insurance company back up the insurance company's contingent liabilities that arise from insurance contracts. We speak about contingent liabilities. They only have to return this money if the insurance buyer gets sick, or maybe the car gets stolen, and so on. Those are contingent liabilities. Only in certain situations the insurance company has to pay back the money. Now, if the insurance company does a good job here and earns a high return on its investment portfolio, then it actually can lower the price for insurance. And this gives it a competitive edge. So if the insurance company can use the return on investments to lower insurance premiums, so this increases the insurance company's competitiveness compared to other companies if it earns a high return on its investment. So the investment portfolio is very important for the insurance company. Now we have risk diversification opportunities here in the so-called underwriting portfolio. That's a risk pooling. So here naturally a lot of people will buy insurance, and not everybody will get sick at the same day. So here actually we have risk diversification. Or not all the houses burn down at the same day. So here we have risk diversification in the insurance portfolio. Naturally, we have risk diversification here on the left side amongst assets of the insurance company. It will invest in different type of assets, not just in a single one. And so also here we have risk diversification. And then we can also look, and we will do that in a later lecture, at the risk diversification between the left side and the right side of the balance sheet. So also between the left side and the right side of the balance sheet, we will have to discuss the risk diversification. But we will see this later. Now let's look here at the balance sheet of Zurich Insurance. Zurich Insurance used to be very active also in South Africa. It's a Swiss company. So amongst assets, here it's for December 31st, it's a balance sheet, so it gives us a situation on a specific date. Debt securities. That's the most important item here. Debt securities, those are bonds. It's not the debt of the insurance company, it's the debt of the issuer. So here's a government issued bonds, and the insurance company buys those bonds. Or we may be a private company issued bonds, bills, and again the insurance company buys it and then earns interest. So that's by far the most important item here. But insurance companies also invest into property, into real estate, particularly in Switzerland. So they have here also $12 billion of real estate. In Switzerland, it's quite common that people rent apartments, and a lot of those apartments are actually owned by insurance companies. But the most important item is actually here, those debt securities. Now, insurance companies sometimes invest into equity, into shares. They are allowed to do this. As we said, it's a banks. Maybe a bank is allowed to do it in some countries. In other countries, banks are not allowed to buy shares. Now here, Zurich Insurance does not hold particularly large amounts of shares. They really invested more into bonds and bills. And they hold some real estate here. And they earn money on that. All the other items, again, are here quite small. Now, the liabilities of Zurich Insurance, the biggest item is here the liabilities for insurance contracts. It's $249 billion here. So that's the item here, those policy liabilities as a present value of future insurance claims. Okay, that's the items that liabilities that arise from insurance contracts. And they list it here in their balance sheet. The $249 billion here. The remaining items are again not particularly large. Yeah, here there are some investment contracts. So here again, it turns out it's a liability of the insurance company. Now, those are the total liabilities. Now the balance sheet total is 395. The liability is 291. So the difference here is again a buffer between assets and liabilities, and that's what belongs to the shareholders. That's again the equity. That's sorry, it's actually down here. That's the equity. So here we have the total liabilities, and then down here we have the equity. Again, okay, those are just for legal reasons. Okay, they mentions this. So that's a buffer stock here, down here. Okay, so those are the assets and the liabilities of banks and insurance companies. And really the banking business is not so different from an insurance company. People pay money into those financial institutions. In the case of an insurance company, you get the money back when you are sick. In the case of a bank, you get the money back, okay, maybe on demand, or maybe after some time. And those financial institutions invest their money and earn interest on those investments. So people typically, when they work in the financial markets, sometimes during their career, they move between banks and insurance companies. They're just financial institutions. Okay, next time we will do a somewhat more mathematical topic. Thank you.